Hi, everyone. A very good evening. And once again, welcome to all of you on this Edelweiss Connect Classroom session. We are doing this on a monthly basis, and genuinely, we thank you for your patronage and support for making all of these sessions a success. It tells us that perhaps we are on the right track, and the sessions that we are doing are helping you to make better informed investment decisions, and that has been our endeavor all through. And I am here with all of you with a very interesting and important topic. It's called 7 steps to a successful investment journey. Right. And the key word over here, or the action verb over here, is successful. Right. And before we get on that, I think it becomes very important for us to think about what is success, right? And whether it is in my professional life, whether it is in my personal life, it's a very individualistic thing. I'm not denying that part, but to know and ascertain whether I am successful or no in whatever endeavor I have embarked upon, it becomes very important that I am able to measure it, right? So whether it's something personal that I want to, let's say, lose some weight, or I want to build some muscle and I want to exercise every day, and or whether I want to get on a better high protein diet, or it's professional where I want to move up in my career. There's a measure that I look at whether I have been able to move or no, and that same thing holds true when it comes to our investment journey also. Right over here, the questions obviously would be, do I have enough as and when I need it? And this will decide whether I have been successful in making the right investment decisions, through which, I have been on that journey wherein I have been able to, somewhere garner enough from my hard-earned money, which is now, sufficient for my requirements. And that becomes very important. What is also to note is that even the most successful investors have not been successful in a day, or from day one, right? It is if I want to be successful in my investment journey, it is very important that I learn the in and outs of the financial world. I understand my own personality as an investor, and this requires a lot of time and patience, along with, of course, a lot of trial and error. Because right from day one, I would not know what works for me, what is my comfort level, what I understand better. And through these presentations, what I'm aiming to do is, leading you to the first 7 steps of your expedition into investment, and show you what to look out for along the way. So that's going to be my endeavor. As usual, please put your queries and questions in the chat, and I will respond to each one of those towards the end of the session. So on that note, let's begin. And the first step to a successful investment journey is, getting started in investment, right? Always remember that if I want to become successful in investing, it is a journey, and it's not a one-time event, right? And you need to think of it as a very long trip, as if you're going on a very long trip. We need to know. So if I were to simply put it in investment parlance, it is about knowing the reason for your investment. It is defining the destination that you know that, okay, now I have enough to do this XYZ activity. It's called a financial goal, and we've spoken before also on this. And but even if it's at the cost of repetition, I would genuinely urge all of us to think of a reason, a tangible reason for investment. It becomes very important, because then you know that you've done something, and that satisfaction when you created money for whatever you want to do is irreplaceable. So think of why are you doing it. Just don't think I have extra money, I'm investing. We'll see what happens ahead. What will happen is, in that journey, you will perhaps make money, you'll spend some money, but that security, that I have enough, or whatever my requirements are, will not get built. So look at this as an example. If you're looking for to retire in X number of years, and over here I'm talking 20 odd years, and you need to know how much you need to do this. You need to know what is your current lifestyle, right? Somewhere with an inflationary, number, try and find out what is going to be your requirements when you retire. Then from there, somewhere maybe even understand, if that is a requirement for 1 year, and your lifespan, is that you would live for, let's say, another 15, 20 years post-retirement, then what is the total value that you would need? It's something which you need to, which you need to ascertain. But the first thing is to find out how much do you need, because unless I know how much I need, I don't know how much I should invest. And if I don't know how much I should invest, then, in my retirement, let's say in this example, when I'm talking of retirement, if let's say retirement is my goal, in my retirement, that insecurity will always be there that I don't have enough. And that will add to my stress levels. Any which ways, age is not on my side. Adding the stress levels would then obviously, somewhere add to my medical conditions. And the easiest way to avoid this is to be better prepared. How do you get better prepared? You get better prepared by thinking how much you require and then planning to create that kind of money. Yes, you would say it's easier said than done, but starting out is the first step. Knowing what you need is the first step. And that is the very most important step that we all should take. So first thing is get started in investing by knowing what are you investing for. It's not returns. It's a tangible, utility that you want to do with your money. It could be anything. It could be that I want to take a holiday. It could be I want to redecorate my home. It could be I want to buy a new house. It could be I want to do something for my children. It could be, anything else. Buy a bigger car, or whatever else it may be. But if you think about it and you give yourself, and you have sufficient time, or whatever time you have, you can plan it smartly and ensure that that money is made available. And that is what gives me satisfaction, when I use my money to what I thought I want to use it for. So get started with a purpose in investment. The second one is know what works in the market. Read books. Knowledge is an investment, in today's times, and it is an extremely irreplaceable and important aspect of whatever I do. Being informed, about various theories, what's the in thing in investing, what are people doing, what are the pros and cons of different investments. There is a lot of literature which is actually available for investing. And we must utilize our time in educating ourselves, in becoming more knowledgeable in this very, very important aspect, which will create, more money for me if I make the right choices, and that will only happen if I educate myself, if I spend time in, enhancing my knowledge. Yes, they say that, investment is a combination of science and art, and that is correct, but what happens, unfortunately for a lot of people, they use it as an art rather than, relying on the scientific bit. The scientific aspect is actually a very, very solid place to start, and it should not be ignored. This is your understanding, knowing what works for you in the market. And then, when you devise some simple rules, which you can apply in your investment principles, and, create an investment, journey basis those investment principles, is what will make you more successful. All successful investors, have set up their own rules, so they've understood, they've read a lot of stuff, they've absorbed, and from their absorption, whatever rings in a larger bell, in terms of their understanding and gets their conviction going is what they've applied. So, for example, very famous investor Warren Buffett has one principle, wherein he says that never invest in businesses that you don't understand. It's a very simple rule and principle that he works with, but it's worked for him. And if I also have certain rules which I set up, that I want to set up my portfolio basis these rules, uh, it will only help me, because then my conviction basis whatever I choose will be higher. So know what works in the market, enhance your knowledge. And if I want to actually be successful in my investment journey, basis my knowledge, create certain principles and rules which will work for me, which I am comfortable with, and basis these rules, set yourself up in your investment journey. So that's the second one. Okay. The third one is know your investment strategy. Now, one thing is I think we will all agree with, is nobody knows me better than better than myself, right? So hence, very honestly, I am my best judge, and of course the most qualified person to somewhere have my own and plan my own strategy. Yes, you need help, right? Investments is serious business. It takes a lot of time. It takes a lot of effort. I'm not saying that you should not take help. As and when you require, you think you must, go and take help from, any distributing partner, if that helps. But I'm the judge. So if my understanding is not there, then obviously, I'll just go with what somebody else is saying. But if I spend my time in enhancing my knowledge, understanding what works for me, what doesn't work for me, then very clearly, what I will also do is, I'll be able to devise my own strategy, with some help, and to do this, it also becomes very important that I identify my personality trait, which will either assist me or prevent me from successfully investing, and manage my personality trait accordingly. I'll show you a small model in the next couple of slides, and through this model, somewhere perhaps, it will help you ascertain what type of a personality you are. So for example, look at this, you have the x-axis and the y-axis. The x-axis scale moves from one side where you have careful to the other side where you have impetuous, which is basically being a little reckless or harsh. Impetuous is a word which is a synonym to these. And the y-axis is the vertical line, which moves from you being confident to anxious. Okay, and basis these, there are 4 personality traits that we have identified. And these names are here. But if I were to tell you in a little more detail, I mean, if you are, let's say, careful and confident, then you'll become more of an individualist, right? And an individualist person is somebody who likes a more do-it-yourself approach. He'll listen to you, but he'll want to do your own thing, do his own thing. So that is what an individualist does. Careful but confident is the block. There are some of us who are confident of our abilities, but we are also very careful. So we listen to people, we'll seek advice, but we'll make our own judgment call. We'll want to do that very individually. We don't want people to make judgment calls for us. So that's the first one. So if you're impetuous but confident, you'll be more of an adventurer. You'll be, let's say, something like an entrepreneurial, a little more volatile. You'll not mind changing, but you're also very strong-willed because you're confident. You're very strong-willed. Like, no, I want to do this. So it's more of an entrepreneurial, mindset that comes in your investment journey. That no, I have done this, made this decision, and this is working. This is what I will make it work. Sometimes, It can be on the negative side also, because then you're not ready to accept that you've done a wrong call. And that may be something which hurts you on the other side, but I mean, these are traits which are there. So this is the second one. The third one is, where you're impetuous and anxious. And the name over here to this combination, what we've come up with is called a celebrity. Now, the celebrity over here is not that you are a celebrity and people are doing what you're doing, but you're basically somebody who is a more follower of trends. So if markets are doing well, you'll invest in markets. If real estates are doing well, you move there. If gold is doing well, commodities are doing well, you'll move there. You are a trend follower. You're okay, till the time you're in that zone where you are seeing, money getting made, you're okay. So you're more of a trend follower, and that we've called it a celebrity. The last one is you're careful and anxious. So you're anxious. You're not confident. You're not very confident, but you're also very, very careful. So over here, the name that we've given is a guardian. You're basically a guardian to your money. You're a wealth preserver. You're risk averse. You don't want to expose your investments to a high degree of risk. And very honestly, we have, most of us will have one dominant trait out of these four. Either we'll be an individualist, we'll be an adventurer, we'll be a celebrity, or a guardian. Right? We'll have one which is a dominant trait. I mean, the first important aspect is that I recognize where I am. Now, whether it's right or wrong doesn't matter. First important aspect is recognize. Then obviously whether this works for my investment journey or no is a question that you need to ask yourself. And if it doesn't work, then you will have to perhaps, go beyond your normal self or beyond your natural self and do something, which is also fine, right? I mean, that's not something which is very difficult, but I will only be able to do that if I first identify what am I. Right? Very few of us, will be something where you'll have a mix, mix of character. And that is why we call that a straight arrow, so mixture of all, a mixture of couple of these, so I am sometimes this, sometimes that. So you swing. A few of us will be there. But if you carefully analyze your, the way you choose your investments and the basis of choosing those, you will be able to tell yourself which of these, in which of these grids are you sitting. And that is a good thing, because once you know where you are, then, you'll either agree that this is a good thing, I'm here and, I want to continue being here. So let things go as it is, which is fine. So even if, let's say, I'm a celebrity and I'm a trend follower, but if that's working for me and I'm creating the money that I need, why change something that's working? Right. But if I'm an adventurer, I'll also then realize that, I should not be so rigid, if things are not going right, maybe it's time that I stop myself, accept that, and make the relevant changes so that, I set that right. But I'll only be able to do that once I identify. So identify where you are, because that's very, very important to understand what's your own investment personality trait. And then, if it's working, let it work. If you think some tweaking and changes needs to be done, you'll only be able to do that if you're more aware of where you are. So know your investment strategy, know your investment personality trait. The next one is know your friends and enemies. There are a lot of people outside, a lot of videos, a lot of information where people are advising that this is what you should be doing. Now, a lot of us sometimes listen to these people and we get swayed. This person is saying this person is influential, so this thing must be right. Now, identify whether this works in your favor or not. So listen to everything. I'm not saying don't listen, but then basis your own personality trait, identify whether this works for you or no. Don't follow blindly. Identify your friends and enemies. There are a lot of people out there giving advice which may actually not work. And or it may be something where they are doing something, for their own monetary gains. And if I fall prey to that, I may be the one who's losing monetarily. Maybe, right? And hence it becomes very, very important that I evaluate everything that I see, everything that I listen, and then judge it whether this fits into my scheme of things, into my personality trait or not. Because if it doesn't, then you need to discard that advice, because that's the only way that is there. Right? So know your friends and enemies is very, very important. And basis this, you need to find your personality or your investing path. There are three broad strategies which people usually work with. One is diversification. We've heard a lot about this in perhaps, don't put all your eggs in one basket. Some people live by this. They, no, I will diversify, and they diversify. And then there are some people who put all their eggs in one basket. My genuine advice to all of these people is that please watch your basket very, very carefully. So there are people who say, no, I am an all equity guy. There are people who will say, no, I don't like equity at all. I am not going to go there at all. So that's okay. I mean, if you don't identify with an investment asset class, nobody can force you to do that, right? But watch your basket very carefully, because now, since all your eggs are in one basket, if that basket is not performing, then, there'll be more stressful times. And hence, watch your basket very, very carefully if you're doing that. Now, the third one is a combination. There are people who take tactical bets, So they'll have a strategy, maybe a diversified strategy that they've set up. And over and above that, they take tactical calls. They think that, okay, markets are going to do well, so they go high on markets, equity markets I'm talking. They think that there are opportunities in certain fixed income pockets which are doing well, which are going to perform. So and markets may not perform as well as those. They will even go there. So they take very, very tactical bets on a core passive portfolio. So they have a portfolio that they pay. So let's say they put a 60-40 as a asset allocation percentage, and I'm taking only two asset classes. Let's say 60% in equity, 40% in debt. But they are open to swing this by 10%. So they can go 70-30 equity debt, or they can go 50-50 equity debt, depending on what they think. So they are keeping that 10% open for them to take tactical calls. Of course, people who are taking tactical calls, are people who are a little more clued in, are understanding markets a little better. And, basis this, they decide on, investments. If you think, it doesn't work, for you, you don't have the time, you don't have the knowledge, until the time you then gain that knowledge. It's better to seek some help, get a strategy set in place, and keep that strategy intact. And that is what, are the next two things. First, have an optimal strategy and stick to it in the long run. Always think long term when it comes to investing. Rome was not built in a day. Right? It takes time. Yes, it's boring. For a lot of us, it's not exciting because, you're not getting anything to change. You're not trying to do something new. So you start thinking, this is doing well, but, I want to do something else. So a lot of people, keep on asking for new ideas in investment, but if that boring is working, my real question is, why reinvent the wheel? You're creating money sufficiently, let's say, for investments. Why do you want to reinvent the wheel? Why are you having second thoughts? A lot of people in today's times, for example, are talking that the markets are touching its all-time highs. So should we do some profit booking? Every 2, 3, 4 years, market touches an all-time high. And then it breaks that and keeps moving ahead, and then people talk of new highs, So that's how it works. So be in it for long term. If you have a strategy, that strategy is creating money, unless there is a real need that you have identified because of which you think that you want to change something in your portfolio. There is actually no need. Think of long term. You've got an optimal strategy created. It's working for you. There may be no need to change. So let it be boring. But boring is good if it's working for you, right? And the last thing is, always be open to learning, be willing to learn. Markets are very humbling. There's always something new happening. And, that's, we should identify what's new, what's driving the markets, what has changed, what is the reason for this volatility that you are seeing, and be, like I said, also be very humble, because you will see at times that, the markets will prove you wrong. It's happened with the best of investors. The important part is that I should acknowledge, my mistake and learn from it. Not accepting your mistake is the first challenge for a lot of us. We don't accept. And if I don't accept that I've made a mistake, then obviously I'm not learning from it. So it's very, very important that, be humble that, if things have not gone right, then accept that, okay, things have not gone right, but I will take corrective action. That's fine. Nobody gets it right all the time. Not even the best of and the most knowledgeable of investors get it right all the time. So you'll always feel something, that is different. You'll always want to do something that is different. Hey, don't do that, be boring, but always be willing to learn. If there is something that is not working, accept it. Find out why it's not working, accept it, and change it. Don't get stuck up. So this is what I had for all of us. As usual, I thank you for your interest and patience in listening to me. And, I would now open this for questions. Please post your questions in the chat. They will come to me, and I'll respond to all your queries and questions with respect to whatever we discussed in our agenda today. Okay, one question that has come to us is, how do you realize that you made a mistake? As I rightly also said, that sometimes it's very difficult for us to accept, that there has been a mistake. So first, obviously, is that you have to be very, very open and non-judgmental to start with. That, and you have to admit. So, for example, that perhaps it didn't work. And how will you first analyze that? Let's say you made an investment with an expectation of whatever X returns, but it's not delivering on those expectations. So you need to understand, why is it not delivering? Is it a market issue? Is it a scheme selection or a stock selection issue, or a security selection issue? If it's a specific issue, then this issue needs to be addressed. If it's a broad market rally issue and the markets by itself are not performing, then obviously maybe you could give it time. If your portfolio and everything else seems fairly positioned. But if that's not the case, then somewhere you'll have to accept that maybe this was a wrong judgment call that you made. And basis that acknowledge that mistake and learn from it. That what was the mistake that you made, and ensure that it doesn't happen in the future. So I think that's the best way to work around it. Anyone else? Any queries, questions? Okay, I guess we don't have any further questions. I genuinely thank you for your time once again and your interest. And as usual, we will meet again in the coming month with another interesting topic, which will help you further understand your investment decisions. And till then, goodbye and take good care of yourself. See you. Bye-bye.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.